Welcome to the Deep Dive. Today, we're taking a scalpel to the Q3 2025 earnings call from PVH Corp.
That's right. The parent company of, Calvin Klein and Tommy Hilfiger.
And we're really trying to get beyond the press release here to understand the real story that's driving the stock.
Especially with that huge market reaction right after the print. It was pretty volatile.
Volatile is a good word for it.
Yeah. And that reaction is really the whole mission for us today. I mean, if you were watching the stock, you saw some major selling pressure.
Right.
And on paper, Q3 looked like a beat. But the outlook, that guidance for Q4 and the full year, it just completely spooked the street.
So that's the tension we need to figure out. Why did a quarter that beat consensus lead to, an almost 12% drop?
Exactly. It tells a story about fear. Fear on profitability and a lot of execution risk.
Okay, so let's start with those headline numbers, the ones that at first glance look pretty positive.
Sure. So PVH reported non-GAAP earnings per share of $2.83.
Which was way ahead of the analyst consensus, right?
Way ahead. They were looking for about $2.56. And revenue came in at $2.294 billion, so just shy of $2.3 billion, also a little bit ahead of estimates.
So superficially, the operations looked stronger than expected.
That is the perfect word for it. Superficially stronger.
Yeah.
Because the market, it doesn't trade on non-GAAP results alone.
And this is where the red flag pops up.
Immediately. You have to look at the reported GAAP net income, which is the the official view of profitability. And it just collapsed.
How bad was it?
PVH reported GAAP net income of just $4.2 million for the quarter.
Wait, what was it last year?
Well, last year, same quarter, it was $131.9 million.
That is not a small dip. Going from over 130 million to 4 million is a seismic shift.
A seismic shift. And the reason for it is directly tied to the flow-through of prior restructuring charges. These are non-cash impairment charges from previous quarters.
So it's related to their big PVH Plus plan restructuring.
Precisely. And the market gets that these are technical adjustments, but a 97% collapse in reported net income, it just suggests that the underlying cost of transforming this business is way bigger than anyone thought.
So investors are basically asking, are these costs really temporary, or are they hiding a deeper problem in adapting a business of this scale?
That's the skepticism. And then you add the top line view to that. Reported revenue was up 2%, but if you strip out the currency volatility.
The constant currency number.
Right. On a constant currency basis, it was basically flat, down less than 1%.
Which is not great for a peak retail quarter.
It's a worrying sign that they just don't have enough pricing power or volume to fight against those macro headwinds.
Okay, now let's talk about the biggest headwind of all, the thing that really drove the stock collapse. Gross margin compression.
Ooh, this is where the pain was. It was excruciating.
The numbers were bad.
Gross margin declined a staggering 210 basis points year over year. It landed at 56.3%. This is the core issue. It dictates everything about future profit.
And management laid out the reasons pretty clearly.
They did. There were 4 main factors driving this compression.
Let's list them, because this really explains all the nervousness.
Okay, so first and foremost, U.S. tariffs.
The big one.
The big one. Second, higher promotional activity, which just means they had to discount more to move product.
Which is never a good sign.
No. Third was increased freight costs, though that is getting better. And fourth, and this one's a bit in the weeds, the internalization of their women's product lines.
Meaning they're taking on costs that licensees used to handle.
Exactly. Absorbing supply chain and distribution costs as they bring it all in-house.
I want to zero in on those tariffs because the numbers they gave were just staggering.
Yeah, this isn't a rounding error. It's a major policy shock that they just have to eat.
So how much did it cost them?
Management estimated the tariff impact was about $1.37 per share headwind just in Q3.
Just in one quarter.
And even more critically, they said the unmitigated impact on their earnings for the full year 2025 is $65 million.
$65 million.
And when you run that through the share count, you realize that $1.05 per share of their potential earnings is just gone, disappearing because of policy decisions they can't control.
Wait, hold on. If they're losing $1.05 per share just to tariffs, that means any growth they generate has to first cover that dollar before a single cent hits the bottom line.
Now you see why investors are so fixated on cost control.
It makes perfect sense.
And of course, management CEO Stefan Larsson, he countered this. He pushed the narrative of operational self-help through their PVH Plus plan.
Right, the growth driver 5 thing.
Exactly. They claim they've unlocked over 200 basis points of SG&A efficiency in the last 18 months.
Which is impressive. 200 basis points of savings is a lot. But here's the question the market is obviously asking.
Go on.
If they saved 200 basis points on SG&A, why is the gross margin still down 210, and why aren't those savings flowing straight to profit?
Because they're explicitly reinvesting those savings. They're not banking them. The PVH Plus plan isn't just about cutting costs. It's about elevating the brands. So all that unlocked SG&A cash is being pumped right back into product innovation, into what they call cut-through full funnel marketing.
And improving the retail experience, like new flagships and things like that.
Exactly. They're sacrificing short-term margin to try and build long-term brand equity so they can, eventually command full-price sales again.
It's a strategic trade-off then. Use internal savings to fund marketing wars, hoping it pays off down the road. So how is this actually playing out at the brand level? Let's start with Calvin Klein.
Calvin Klein actually showed some pretty effective execution, especially in their core categories. Total revenue was flat on a constant currency basis.
But inside that number,
Inside that, their underwear segment, specifically the Icon Cotton stretch line, saw explosive 20% growth.
20%.
Yeah, and that was fueled by those massive global mega talent campaigns. We're talking Bad Bunny, Rosalia, Jungkook.
So that strategy is clearly working. That star power is driving desire in their most profitable category.
It absolutely is. Tommy Hilfiger was a little softer.
Yeah.
Down 2% constant currency.
What's the story there?
Well, the marketing stuff like the Hilfiger Racing Club and the F1 tie-ins got a lot of attention, but the brand just struggled a bit more globally to hold volume compared to Calvin Klein's strength in underwear.
So for them, it's more about retail elevation, like that new Tokyo flagship.
It is. Focusing on key markets and really elevating the in-store experience.
Regionally, the picture sounds like a bit of a mess, a mosaic of extremes. Where was the good news?
The good news was definitely Asia Pacific, or APAC. It was the clear bright spot.
Okay.
It showed that their direct-to-consumer strategy can really pay off when the execution is perfect. Revenue was flat constant currency, which actually beat their expectations.
And China was a big part of that.
China was the standout. Their big Double 11 activation drove gross merchandise revenue up 15% from last year. It just proves that in markets where the consumer is still engaged, PVH can capture that growth.
But the operational headache, the real execution risk that had the market so worried, that was Europe.
That was Europe.
What happened there? Why was it so bad?
So Europe saw revenue decline in the low single digits.
Yeah.
And it was a mix of both macro weakness and an internal operational failure.
Okay, break that down.
On the macro side, they just faced a tougher backdrop after September. The consumer was sluggish. But the critical internal issue was tied to the PVH Plus plan itself.
How so?
This big project to centralize the global Calvin Klein product capability in New York, which is a good long-term strategic move, caused a severe, but they say transitory, strain on their European distribution center.
Help me understand that. A strategy team in New York messes up a warehouse in Europe.
Exactly. When you centralize product management and start re-engineering your supply chain, you create immediate pressure points. In this case, the shift led to bottlenecks in the European DC, and management admitted this resulted in lost full-price selling weeks.
Oh, that's devastating. If you miss your window for full-price selling, you're forced to dump inventory later at a discount.
And that flows directly into that 210 basis point gross margin compression we talked about. It's a self-inflicted wound on top of all the macro weakness.
It connects all the dots.
It does.
Yeah.
And to add one more layer of uncertainty, they also announced that the CFO, Zach Coughlin, is leaving at the end of December.
Not great timing.
Not great timing. It just raises more questions about stability right in the middle of all this.
Okay, so all these things, the tariffs, flat revenue, margin compression, the Europe headache, it all comes down to the market's real obsession, the guidance.
Guidance.
Why did the Q4 outlook trigger such a brutal sell-off?
Because it suggested that these headwinds are not going away quickly. While they narrowed the full-year non-GAAP EPS guidance to the high end, which looks good.
There's a but.
There's a big but. The specific Q4 2025 guidance was the major disappointment. They projected $3.20 to $3.35 per share. The street was expecting something closer to $3.61.
That's a huge miss baked into the holiday quarter forecast. Investors would hate that.
It signals that either that tariff drag is proving harder to handle than they planned, or the softness in Europe is just not going away.
And the revenue outlook confirmed it.
It did.
Yeah.
They expect Q4 revenue to be down slightly on a constant currency basis. So the market read that as management saying, we can't offset the $1 of 5-second tariff drag, and we can't guarantee European growth anytime soon.
So the stock dropped almost 12%.
And the narrative has officially shifted from, we believe in the PVH Plus plan, to show us the money, show us the margin recovery.
Very deep skepticism.
Management is constructively bullish, but investors are firmly in a show-me period. They want to see those SG&A savings actually turn into margin expansion by 2026.
Okay. We have covered the tension, the technicals, the flaws, the guidance disaster. Let's shift gears now. Let's talk about our segment where we explore a, let's say, high conviction, outrageous but plausible trade idea based on all this volatility.
And the critical reminder here. This is not financial advice.
Not financial advice.
We are just analyzing a market structure and exploring a thesis based on this volatility spike.
Yeah.
You have to do your own research, talk to a professional.
Absolutely. So with PVH trading at a huge discount, 30% below its 52-week high, and the stock looking cheap based on a 2026 recovery, how do you structure a play?
How do you play that acknowledges the current fear, but also capitalizes on the long-term strength of Calvin Klein and Tommy Hilfiger?
Right.
The thesis is simple. The $1.05 tariff drag and the European hiccup are temporary tempo issues, not structural flaws in the brands. And those 200 basis points of SG&A savings provide a strong cash floor.
So how do you structure a position that's cheap up front but has a big potential payoff if the plan works over the next couple of years?
You use a structured equity derivative position.
Yeah.
Because the options premiums are inflated right now, which actually works in our favor.
Okay, walk us through the components.
First, you buy a long-dated call option, say 18-month or 2-year expiration. You target a strike price near $100, which is where some of the more optimistic analysts have their price target.
That's your pure bet on a full recovery by 2026. But that option will be expensive.
It will be. So to finance that expensive long bet, you use the current fear in the market.
How?
You simultaneously sell short-term, far out of the money put options. For example, you could sell a 3-month put with a strike price down around $65.
And you collect the premium from selling that.
You collect that premium, which comes from the market's high fear, and it substantially reduces the cost of your long-term call option.
So you're betting the stock will execute, rise back toward $100 in 2 years, and that the $65 floor is safe because the brands are strong enough to prevent a total collapse in the next 3 months.
It's an aggressive bet on management execution overcoming macro noise. It's a structure that directly capitalizes on the divergence we've been talking about all this time.
All right, let's sum up this deep dive. PVH delivered a successful Q3 beat driven by strong operational efficiency and some real brand momentum.
Especially in Asia and with Calvin Klein underwear.
Yeah.
But that success was just completely overshadowed by that very conservative Q4 guidance.
Which signals the crushing, persistent impact of that $1.05 tariff headwind and those costly, self-inflicted operational failures in Europe.
The fundamental brands are strong. The cost savings are real. But the question is all about tempo. The market wants proof that PVH can regain control of its gross margin now, not just cut costs to stay stable.
Which brings us to our final provocative thought for you to consider.
Go for it.
Given that PVH is taking their 200 basis points of SG&A savings and reinvesting every single penny into marketing and fancy retail concepts, can these internal efforts generate enough new full-price consumer traffic fast enough to offset massive geopolitical shocks like tariffs and a sluggish European consumer?
And can they do it before that reinvestment money runs out? That is the pivotal challenge. It's what determines if PVH is a growth story or just a challenge value play for the next 2 years.
We appreciate you joining us for this deep dive into the complexity of the PVH Corp earnings report. Until next time, we hope you take this knowledge and find your next edge.